Good day, participants. Now today we would be talking about chapter number 18 of the subject risk management and insurance plan. The subject, this chapter heading is insurance companies. This tells about the various types of insurers, about rate making, about underwriting, about claim settlement, reinsurance, reinvestments, financial reserves, and about selecting insurance companies. So we would be talking about these topics, although some of the topics have been covered in the earlier chapters also. So we would broadly be covering those topics which have not been covered so far in the earlier chapters. Talking about the types of insurers. By now, most of the participants would be aware that life insurance, there are insurance companies like life insurance companies, non-life or general insurance companies. Then insurance companies can also be grouped as health insurance companies. Then there are separate reinsurance companies. There can also be another classification of captive insurance companies, and there are also some what known as third-party administrators. Life insurance companies we have been studying about in the previous chapters. Life insurance companies are those companies which cover human lives. They mainly cover the basic risk of death and longevity. Death risk they cover by various insurance plans like endowment plans, term insurance plan, whole life plans, unit linked plans, etc. Whereas the longevity aspects also they cover in the form of various annuity and pension plans. Talking about non-life or general insurance companies, they again have various forms of insurance like fire insurance, motor insurance, then marine insurance, which deals about transit insurance. Marine insurance can be in the case of transit by sea, by air, by road, by railway, etc. Then there is another kind of insurance which is known as miscellaneous insurance, where household policies, agricultural insurance, crop insurance, etc. or cattle insurance are covered. Then there is another department in general insurance company which is called engineering insurance, which deals with large industries, industrial risk. So these are the broad classification of general insurance companies. Then there are other insurances also like money insurance, overseas insurance, medical insurance. Up till now in our country, in India, health insurance or medical insurance have been covered by the general insurance companies only. Today also, most of the general insurance companies are providing this health insurance or the so-called mediclaim or medical plans. But recently, since the last 1 year, regulating body in India, IRDA, has also sanctioned license to set up standalone health insurance companies. Health insurance companies are very popular, or there are a lot of health insurance companies in the Western countries, especially in America and UK, in other European countries, in Australia, etc. But health insurance companies as standalone companies have recently arrived in India. Recently, 2 licenses have been given in India. One is a license to Apollo DKV Health Insurance Company, which is a venture of the Apollo group of hospitals. And the second license has been given to the Star Health Insurance Company, which is a Chennai-based group. So in the coming years, health insurance would expand a lot, and these companies are likely to offer a wide array and wide diversified kind of health insurance plans. And recently we have seen that Indians have also become very health conscious, and so there is a need to cover the health aspects of the person. And unlike in the conventional medical plans offered by general insurance company, we see that after a certain age they don't give this medical cover or health insurance cover. But currently, as it is popular in Western countries, health insurance is given to individuals throughout the life. For example, managed care plans, long-term care plans, etc. Then there are other reinsurance companies, which is a specialized kind of a business. Reinsurance is a different aspect of business which gives insurance covers to the insurance companies. That is, they cover the extra risk taken by the insurance company. Extra then risk, we call it the risk exceeding the retention limit, because every insurance company has its own retention limit. So if they have sold the plans in excess to the retention limit, so that those kind of risks they can further transfer it to another insurance companies which are specialized in this form of insurance, which is insurance companies. We will be talking about it subsequently in this chapter. Then there are another form of insurance companies which are called as captive insurance companies. Captive, as the name suggests, these insurance companies cater to one industry or one group of industry. For example, a large, say, industrial conglomerate can set up its own insurance company which insures only its group's companies. So that is known as captive insurance company. So far we don't have any captive insurance company in India, but in other countries like in US, we have big industrial houses having their own captive insurance company. For example, we hear about captive generating power plants. So those generating power plants which only cater to the power requirements of their own industries, they are known as captive generating power plants. Similarly, captive insurance companies. Although another aspect which is third-party administrators, although they are not insurance companies, they are intermediaries, but third-party administrators, or commonly known as TPAs, they have become prevalent in our country since the past 4, 5, 6 years since liberalization. And TPAs are companies which are intermediaries to health insurance companies, or which are intermediaries to general insurance companies for their health insurance plans, for their medical plans. Earlier, companies which used to offer medical plans, they used to deal directly with the hospitals and the nursing homes. So whenever the insured person used to fall sick, had to be hospitalized, so the customer first of all had to pay the bills of the nursing home or the hospital, and then the insured used to claim amount from the insurance companies. And then insurance companies had to do all kinds of inquiries so that the law of indemnity is not breached, so that the same claim has been given as the expenses were incurred by the person. But then it created a lot of complication for the insurance company. It was not possible for them to manage the claims, and then it was not possible for them to manage large nursing homes, and then to decide which nursing home is authentic, which is not, which bill is authentic or not. So now they have appointed an intermediary called TP, or third party administrators, who have empaneled a number of doctors or nursing homes or hospitals or clinics with them. And in case the insured person who has taken such a health insurance plan falls sick, so he or she has to contact this third party administrator. The address and contact numbers would be given in the insurance policy. So then the third party administrator or the TPA would suggest them to go to a particular doctor, and then directly the bill would be routed through the TPA. The customer doesn't have to pay the bills, hospital bills, etc. So it's also a kind of a cashless service to the customer. So it's a win-win situation for all. For the customer, it's an easy and swift process without paying any cash. Secondly, it's also easier for the hospitals or the nursing homes to get their bills processed, and it is easier for the insurance companies also. So this is another kind of intermediary, which is so many companies are operating in India as TPAs. We have Raksha TPA, we have several other companies, in India. Now we have another topic which is about rate making. Rate making is about pricing of insurance. Now, pricing of insurance, although it's a very complex process, it's an actuarial process. We are not discussing the entire process here because it's beyond the scope of our subject. This is basically dealt by the actuarial science. But basically we will see what are the elements involved in the pricing of insurance. Well, as by now we know that insurance pricing differs considerably from the pricing of other products. It's not like any other products, industrial product, wherein we just have to calculate the costs of production. We have to add a suitable margin in it, and then add selling expenses, distribution expenses, etc., and then sell it in the market. Unlike those products, here Based on the law of probability, the actuaries have to look at the past data, past statistics, not of 1 or 2 years, but of 10, 20, 30 years. And then they also have to make future forecasting depending on those past probabilities. They have to also make sales forecasting for future. They have to make risk forecasting for the future. They have to calculate the rate of interest. They have to calculate the present value of the money. They have to calculate the premium. Then they have to calculate that what would be the amount of interest that would be earned on this premium. So after deducting that amount of interest that is likely to be earned on that premium, they then calculate the net premium from the. Then they add various expenses like administrative expenses, selling expenses, underwriting expenses to it, and then finally they arrive at office premium, so-called. And that office premium also, again, they have to make certain adjustments. For example, in certain ages, there would be less fluctuation. For example, we know that as the age increases, in the case of life insurance, the premium of a person increases, or because the mortality rate increases. But in certain ages, they find from the actual results or from the actual statistics that at a lower age, the mortality rate is more. Higher age, mortality rate is less. So they have to make those kind of adjustment. And after making those adjustments, then they arrive at the tabular premium. So they have to calculate the rates so that they remain solvent. The insurance companies have got adequate reserves because insurance is basically a business of liabilities. And they cannot say after one financial year that yes, they have made so much profits. So their profit and loss account statements are also different from any other conventional business. At the year end, when they do their valuation, they can say that yes, these were our expected claims and these were our actual claims at the end of this financial year. So they will, if the actual claims are less than their expected claims, they will deduct actual claims from the expected claims. So the figure that they will arrive at would be known as the reserves. That is the reserves. That is still they're not profit. It's not their profit. They can't say it's their profit because next year there may be more claims. In the coming years also. So in the coming years they have to calculate what would be the future premium which would be received in the coming years and what would be the liabilities in future years. So they will calculate the present value of the future liabilities. They will also calculate the present value of the future premiums to be received. So they will factor in those liabilities and the future premiums in the reserves. So that means they will deduct the future liabilities also accordingly, net future liabilities from the reserves. They have to keep aside those future liabilities. Then the net amount from the reserves minus the future liabilities, the amount which they will get will be known as the surplus. Now this is the surplus with them after keeping aside or setting apart the future income and future liabilities. So this surplus they can distribute among the policyholders. So Insurance Act says that 90% of this surplus has to be distributed among the policyholders as bonus, and 10% of this surplus can be distributed among the shareholders. Only shareholders are liable to get only 10% of this surplus. So this is how the pricing is done. It's a complex mathematical process involving all aspects of statistics, economics, finance, insurance, etc. Now we have another topic in this chapter which is about underwriting. Underwriting, well, it's a process of selecting and classifying the various risks and classifying applicants for insurance. Underwriting is also, we can say, it's a form of assessment of the risk. It's a process of assessment of the risk carried by a person. In the case of life insurance, we assess the life and death risk on a person based on the data provided by the person. In the case of general insurance, for example, it's a motor insurance again. The person who is doing the insurance, the intermediary, is supposed to have a physical verification of the vehicle in case it's an old vehicle. In the case of building also, proper verification has to be done. So accordingly, they will classify the risk, whether it's a standard risk or A class risk, B class risk, C class risk, and accordingly it would be charged. Sometimes they have various options. They can even reject a particular proposal. They can accept a proposal on standard terms and conditions. They can accept a proposal on some modified terms and conditions. They can increase the premium. They can reduce the term. They can offer a small sum assured. They can put a lien on the proposal. Liens means some condition. For example, first few years the sum assured would be more, and then subsequently the sum assured would keep on reducing. So this kind of condition or lien they can put. If they find that certain person is health is going to deteriorate in the coming years, they will offer him any decreasing sum assured. In some cases, they can offer a plan with increasing sum assured, with increasing premiums. So these kind of conditions they can put. Now, underwriters, we hear the word underwriter. Underwriter is the person who has the authority to decide about the acceptance or rejection of an application. So fundamental objective of underwriting is to maintain the solvency of the insurance company, to maintain the reserves, and to maintain a profitable account in the business. Basically, insurers act as the trustee of the funds of the people. So basically, trustee of the pool of funds. And since a large number of people pool together their money in order to share their losses, so therefore, large number of people would be bearing the risk of a few unfortunate people who will incur the loss. So therefore, this is as a trustee, this is the duty of the insurer to see that the correct people enter this pool of funds, and finally the claim is also given to the right claimants. So therefore, underwriting is the process of checking the entry of the people, checking the veracity of the persons. And while in the claims, it's about checking the, you can say, exit of the money from the pool of funds to the people. So there are two aspects. One is at the entry. So entry stage is basically underwriting. So essence of underwriting is risk recognition, assessment, shaping, containing, and even pricing. In certain countries, even underwriters are also involved in the pricing of the product. Although in our country, pricing is taken care by the actuarial department, underwriting is a different department. Now we come to another topic, which is known as production. Now the participants would wonder what production has to do with insurance company. Production we hear in a manufacturing company. Well, here production, it's a term borrowed from foreign insurers. They use this term production vis-a-vis insurance in relation to sales and marketing activities of insurance. Because basically the sales and marketing is the most crucial arm of an insurer. So therefore they call it as their production. And agents or intermediaries or any person who sells insurance plan are known as producers. So it's a saying in insurance industry that nothing is produced until a policy is sold. So therefore they use this word synonymously with selling and marketing. And the key to the insurer's financial success lies in its effective sales force. So therefore insurance company have to build proper intermediaries, they have to give them proper training, they have to tell them about sales procedures, about proper selling, about ethical selling, and this is the duty of the people who are selling insurance plan, not to do any mis-selling, because utmost good faith applies to both the parties, to the seller also and to the buyer also. In this case, the buyer is supposed to reveal all the material facts relating to the object of insurance. Similarly, the insurance who is selling the plan is also supposed to reveal all the terms and conditions and all the provisions in the insurance contract. In case of any unpleasing term and condition also, it has to be revealed before the customer. Now coming to reinsurance. We were talking about reinsurance at the very outset of this webinar. Reinsurance is, in a very simple and layman term, we can say it's the insurance of insurance companies. Insurance companies are further reinsuring their risks to another entity which is known as a reinsurer company. The company who insures its risk, the insurance company who insures its risk is known as the ceding company. C-E-D-I-N-G, ceding company, and the company who is reinsuring is the reinsurer. Many times it happens that insurance companies are getting a lot of business from the market. They want to sell their plans, but they have a certain retention limit. Retention limit is again an actuarial term. That is, they have the risk which they can retain. Like we had talked in the very first chapter about the retaining of the risk. If I can bear the loss, then I can very well retain the risk. But if the loss is of such a magnitude or it can be of such proportion that I may not be able to bear it, I would be in a lower financial position, so then certainly I should transfer my risk. But such certain risks I can retain. So similarly, insurance companies also have their retention limits. These limits are fixed after each valuation every year. And as the insurance company grow old, the retention limits become larger because of the life fund. The regulating body also has to see what is the retention limit of the company. But sometimes when the business, it exceeds the retention limit, then if what happens if all of a sudden if a large loss happens? So that means the insurance company will have to part with their large life fund. Now this large life fund, irrespective of the fact that it is large, but this life fund was because of selling off, say, 1 lakh policies. Now the loss has happened with 2 policies. Now they have to give this major chunk of their life fund to these 2 policy holders. So that means it would be unfair to the other policy holders because they have depleted their life fund. So therefore it is necessary for them to retain a certain part of life fund. So if they are getting business of a certain amount, so they can reinsure it with another insurance. So the reinsurance companies again charge them certain premiums, and now the reasons for reinsurance to even out irregular claim patterns so that their solvency is maintained, to protect against losses from any single catastrophic event. Suppose there is one single catastrophic event, they will be in a heavy, you can say, poor financial position, to reach more clients and to expand capital reserves and further risk transfer. These are the various reasons for reinsurance. Now, type of reinsurance, there can be 3 major types of reinsurance. One is facultative reinsurance, other is treaty reinsurance, and the third one can be a hybrid of the 2, the facultative and the treaty. Then again, treaties can be of 4 types. One is quota share treaty, other is surplus share treaty. Then we can have excess of loss treaty. We can have reinsurance. Now let's talk about investments. There is another topic called investments. As we had talked about it earlier also in this webinar, that insurance function is very important function for the insurance company, and the premiums which are collected by the insurance companies are generally also meant for the economic upliftment of the country. They are used for the economic development of the country. This money is used in various government bonds, government securities, which further government uses for sanitation, for building infrastructure, for roads, for primary education, for primary health, etc. Since premium are received in advance, so they are invested in the required investments. So they have to follow the dictats or the regulatory directions of the regulating body, and according to the Insurance Act, if they have to invest, they have to give a higher return, then certain part of risk has to be borne by the policy holder himself or herself. Insurance companies also have to maintain their financial reserves. Talking about financial reserves, as I talked earlier, that's the difference between the present value of the future benefits and the present value of the future net premiums. So they have to maintain the reserves in order to maintain their solvency. Again, reserves can be retrospective reserves, they can be prospective reserves. Retrospective reserves are the reserves calculated from the date of the starting of the policy. They will see that when the particular policies were started, so from that date they will calculate the retrospective reserves. Prospective reserves, they calculate reserves in the current year, irrespective of when the policy had started. Now the last topic of this webinar, selecting insurance companies. Well, as a customer, one should select insurance companies based on various parameters such as financial strength of the company. One has to see the goodwill which the company enjoys, the solvency figures of the company, the corporate ethics followed by the company, the social responsibility of the company, because now corporate social responsibility is also assumed great importance in the corporate sector. Its past claim record, of course, and customer service quality, the promptness of issuance of policy, the promptness of underwriting, the promptness of issuing of premium receipts, etc. So based on this, the customer can select an insurance company, and the company which would follow all these parameters would be successful in the long run, because it's a long-term business, and there is a great scope of insurance sector in India, and we hope that this sector will grow and boom in the coming years also. Thank you very much.